Okay, let's unpack this. If you're tracking the world of private credit in Europe, especially around distressed assets, you very quickly run into a legal structure that is absolutely foundational. It's the Luxembourg SICAV RAIF SCA. Today, we are taking a deep dive into that specific toolkit, the one chosen by private debt managers and credit funds targeting, all those stressed loans and non-performing exposures, the NPLs in Italy. Our mission isn't just to define the acronyms, it's to really get a quick handle on why this specific vehicle is so robust, why it combines efficiency and governance in a way that's made it the go-to for these incredibly complex, high-stakes fund strategies.
And if we connect this to the bigger picture, you have to recognize what these fund managers are actually up against. Italian debt restructuring. It's a multi-year and frankly often messy process. It requires an investment platform that can manage incredibly complex cash flows, handle workout scenarios that last for years, and maybe most importantly, provide a reliable framework for enforcement. And that's what Luxembourg provides. That legal certainty under EU law, plus a very mature ecosystem that's, well, it's specifically designed for these types of alternative investment funds.
So let's start with the assets they're hunting. You mentioned NPLs, non-performing loans, but the sources also highlight UTP's underperforming loans. What are the key strategies here that demand such a specialized structure?
Well, they are targeting portfolios of both NPLs and UTPs, and the strategies go far beyond simple refinancing. We're
Right.
talking about outright acquisition, yes, but also really active management and resolution of debt positions, special situations credit, and rescue financing, particularly for companies that are going through restructuring under Italian insolvency law.
That sounds like a heavy lift. We're not talking about liquid assets here.
Absolutely not. And the sources emphasize that the SICAV RAIF SCA is specifically suited for hold-to-workout strategies. This is a critical distinction.
Hold to workout.
Exactly. It often involves hybrid debt equity plays, which means the fund might actually convert its debt into equity during a restructuring. This requires a structure adapted to handle deeply irregular cash flows.
Okay, so you're spending capital for years before you see a recovery.
And that recovery usually comes in lump sums after some sort of legal closure, not steady quarterly returns.
And if you're holding something for, say, 5 to 7 years, maybe battling it out in Italian courts, why does the fund structure itself need to be in Luxembourg? Couldn't they just use a simpler vehicle closer to home?
That's a really important question. The complexity demands stability and, crucially, investor familiarity. The fund structure has to be closed-ended with a defined term, and it needs to support staged capital deployment.
So the manager calls capital only when they need it for a deal.
Precisely. And Luxembourg provides that compatibility with EU professional investor marketing rules, the AIFMD passport, and the institutional governance standards that attract, multi-billion-dollar commitments from major global investors. They need a vehicle they recognize and trust.
Okay, let's unpack the toolkit itself then. Here's where it gets really interesting, the nuts and bolts of the legal structure. SICAV RAIF SCA. It's a marriage of two key legal elements.
That's right. The first component is the RAIF. That's the Reserved Alternative Investment Fund. The strategic advantage here is, in a word, speed. Because it's reserved only for well-informed investors, the fund itself is indirectly supervised.
Wait, so the key to speed is actually less direct regulation.
Precisely. The fund product itself remains unregulated at the product level, which translates into a much faster time to market. And this is crucial when you're trying to acquire distressed debt portfolios where speed can be the difference between winning and losing a bid.
But it's not totally unregulated, is it?
Not at all. It operates within the strict EU AIFMD framework because it must be managed by an authorized AIFM, an alternative investment fund manager. And the AIFM is fully supervised by the regulator.
So the AIFM is the heavily regulated engine ensuring compliance, which then allows the fund structure, the RAF, to be this flexible, fast-track chassis. That makes perfect sense for balancing speed and institutional credibility.
Exactly.
So now for the second element, the SCA, what does Société en commandite par actions actually bring to the table in terms of governance?
The SCA is essentially a corporate partnership limited by shares. And this is key because it mirrors governance models that are very familiar to international credit fund investors, especially those who are used to the US and UK limited partnership structures.
And why is that mirroring so important?
Because it creates a very clear separation of function and risk. The structure features a general partner, or GP, which holds unlimited liability and controls the day-to-day management and strategic decision-making of the fund. That accountability is absolutely central.
So the general partner is the fiduciary anchor. And that protects the investors.
It does. The investors, who are the shareholders, they benefit from strictly limited liability, which is confined only to the capital they subscribed. This protection is foundational for attracting massive amounts of capital into what are inherently risky, distressed debt plays. It's governance clarity paired with liability protection.
Okay, so if the SCA provides the governance and the RAF provides the speed, let's talk about the operational reality. Because the best legal structure is useless if the back office can't handle the multi-year slog of an NPL workout. What does that setup entail?
This is where the structural advantage meets the real world. The operational setup requires a meticulous process: defining the credit strategy, selecting the authorized AIFM, choosing all your service providers, and maybe most importantly, setting up highly complex processes for investor onboarding, AML compliance, and ongoing reporting.
And if the fund is deploying capital into Italian assets, but the investors are from all over the globe, what specialized infrastructure does Luxembourg provide to connect all those moving parts?
Luxembourg provides the whole ecosystem: fund administration, depository oversight, audit, valuation support. But the real difference maker is the complex banking services they offer.
How so?
These funds live or die by their ability to accurately manage complex cash waterfall calculations.
Right.
Figuring out which tranche of debt gets paid first, which investor gets their priority return, in which currency, and conducting these multi-currency operations flawlessly over sometimes a decade.
I think we need to stay on that cash waterfall complexity for a second. This isn't like a standard monthly rent check coming in. A manager might spend 5 years fighting a claim and then suddenly realize a massive recovery.
Yeah.
How does the structure make sure that money gets distributed fairly and accurately, like immediately?
It's all codified in the constitutional documents of the fund. It's managed by the fund administrator and overseen by the AIFM. Because the cash flows are so irregular and large, the system has to be robust enough to handle the combination of interest income, asset sale proceeds, debt recoveries, all while sticking to the specific priority rules set out in the fund's LPA. The operational excellence of the Luxembourg infrastructure is, arguably as vital as the legal framework itself.
That makes sense. Okay, let's tackle the elephant in the room: tax. The vehicle's in Luxembourg, the assets are in Italy. How do they link that tax-efficient wrapper to the Italian enforcement rules?
This is really the genius of the two-tier structure. From a Luxembourg perspective, the SICAV-RAIF is generally not taxed on income and gains at the vehicle level.
Okay.
It's subject only to a minimal subscription tax, and even that can have certain exemptions. The whole point is to keep the investment vehicle itself neutral from a tax perspective.
So the tax hit is pushed down to the investor's home jurisdiction. But how does the fund physically hold the Italian loans?
That's where the dedicated SPVs, or special purpose vehicles, come in. The Italian debt assets, the NPLs and UTPs, are typically held by these SPVs, which are incorporated in Italy. This is absolutely necessary to align the portfolio with local Italian tax, regulatory, and critically enforcement rules.
So you have a Luxembourg umbrella, the RAIF, holding Italian SPVs, which in turn hold the actual distressed loans. That sounds like a minefield for tax professionals.
Oh, it absolutely is. It requires a detailed, multi-jurisdictional tax analysis. You're dealing with complex income streams. You have interest from the loans, recoveries from legal enforcement, and potential capital gains if the restructured assets are sold. The tax treatment has to be assessed at the investor level, the Luxembourg fund level, and the Italian SPV level, all at the same time to optimize the overall return.
And beyond tax, what about governance during the actual workout? If the GP needs to make a huge decision like convert debt to equity or start an aggressive enforcement action, how does the SCA structure ensure investors are protected and conflicts are managed?
That governance is meticulously defined in the fund's constitutional documents. The structure includes a clear allocation of powers, strict investment and concentration limits, and it very often uses advisory committees made up of major investors.
Right, so the big players get a say?
They get a say in reviewing conflicts of interest and signing off on these high-authority decisions. And that level of mandated transparency is necessary because these decisions often involve hundreds of millions of euros and years of strategic planning.
And finally, a quick reminder about who this is all built for.
Right. The SICAV-RAIF is strictly reserved for professional and institutional investors across the EU under AIFMD rules. This is not a retail product. And the marketing documents have to specifically reflect the risks of Italian debt restructuring. The investors must be acutely aware of the, legal enforcement risk, the timing uncertainty, and the macroeconomic sensitivity of that market.
So what's fascinating here is why this specific SCA-RAF combination ultimately wins out over other partnership structures. For example, why not a simpler SCSP, a special limited partnership, which is also popular in Luxembourg?
The choice often comes down to investor preference and strategic flexibility. The SICAV-RAIF SCA is preferred when global investors, especially those from outside Europe, specifically expect a corporate fund format rather than just a simple contractual partnership.
I see.
When share-based participation is a requirement, or when the manager expects complex reinvestment or refinancing cycles within the fund's life, the corporate structure just offers distinct advantages. The SCA's rigid separation of control and liability, paired with that corporate format, provides maximum comfort to the largest institutional players.
So it's about providing the regulatory flexibility needed for the strategy and the corporate wrapper and credibility needed to attract the biggest pool of institutional money you can get.
Exactly. This structure provides a stable long-term platform that managers can use for successive fund vintages, co-investment vehicles, and continuation strategies. It is the gold standard for balancing contractual flexibility, regulatory alignment, and investor credibility for European distressed debt.
So what does this all mean for you? We've seen how the combination of the RAF, which provides regulatory efficiency and speed through indirect supervision, and the SCA, which provides governance clarity and limited liability through its corporate partnership model, creates the ideal wrapper. The ideal wrapper for these complex, multi-year distressed credit plays in Italy. You now have the full picture of the core components of this essential financial tool that underpins a huge portion of European debt resolution.
And to leave you with a final thought, think back to the importance of that operational alignment we talked about. The multi-currency operations and the complex cash waterfall calculations that span multiple jurisdictions and years. The sheer requirement for operational excellence in the fund administration infrastructure is arguably as vital to the success of these long-term strategies as the initial legal framework itself. So if this highly sophisticated solution is required just to manage debt restructuring, what other complex cross-border strategies currently being managed in simpler jurisdictions might benefit from upgrading to this level of operational support?
That is a fascinating challenge to consider, the ultimate value of the back office. Thank you for joining us on this deep dive into Luxembourg's essential financial toolkit. And remember, next time you read about cross-border SPVs in distressed debt, know that a detailed tax analysis is always required whenever interest income, recoveries, and capital gains are combined. The simplicity of the SICAV-RAIF on the surface hides layers of operational and legal genius underneath.